This is a debrief of drafting and interpreting financial statements, AAT's Sample Assessment 1, Task 4. So Task 4 tends to look at some accounting standard issues. So let's have a look at the text that we've been given here. So Buzz Limited is a manufacturer of electrical appliances. The Finance Director is preparing the financial statements for the year ended 31st December 20X1. So notice we've been given a date here, and the dates are significant because we may have events before or after that date. We may need to do some time apportioning. Remember, you do have a highlighter tool in the exam, and we'd recommend that you highlight every single date that you see in the question to help you take into account that there are different dates and they may be relevant to your answer. Anyway, so it tells us that the Finance Director has brought the following matters to your attention. So let's look at matter 1 to begin with. So a legal action was brought against Buzz Limited in November 20X1. So again, that's before the end of the year, by a former employee who is claiming compensation of £50,000 for unfair dismissal. Buzz Limited solicitors advise that there is a 30% chance that the claim will be successful. So notice they've given us two numbers in the text, and normally those numbers are there for a reason. When the examiner is writing the question, the numbers are not there just for a bit of padding. Numbers are provided because they give us something to talk about. It gives us a potential for earning marks. So in this case, we've been sued by somebody, and hopefully that's bringing to your mind that there's a potential liability. Now, we don't know whether there will be a success in this or not, but the solicitors have said there is a chance that it could be successful. So that means we need to think about provisions. So remember the definition of a provision, it's a liability with uncertainty. So either there is uncertainty over the amount, or there is uncertainty over whether or not we'll actually pay. So in this case, we have uncertainty over whether or not we will pay. So they're claiming the compensation, but there could be some uncertainty over that as well, couldn't there? Because when we go to court, the courts may decide that a different amount of compensation should be paid. So we need to look at IAS 37 for this. So here is the text from the standard. So we need to look at whether or not we should recognise a provision for this. And in paragraph 14, it tells us that a provision shall be recognised when the entity has a present obligation, either legal or constructive, as a result of a past event. It is probable that an outflow of resources embodying economic benefits will be required to settle the obligation, and a reliable estimate can be made of the amount of the obligation. So notice that we have A, B, and C here. So potentially by just referring to these could get us 3 marks in our answer. Although from my point of view, notice I've highlighted 2 different phrases in part A. I've highlighted present obligation and I've highlighted past event. So when I'm writing my answers, I try to separate those, hoping to earn 1 mark for each rather than 1 mark in total. So by transferring these 3 paragraphs into our answer, hopefully we've got at least 3 marks for doing that. And then we need to identify whether or not we meet the conditions in this particular case. So we're told that an employee is suing us, so that is the present obligation. Yeah, we have and they're taking us to courts, that's a legal obligation rather than a constructive one. Now, while we're talking about this, what does a constructive obligation mean? That's where we have an obligation based on perhaps historical activities, so there is an expectation that we might do something. So, for example, if you think about retail stores, if you buy an item of clothing, for example, you take it home and try it on and it doesn't quite fit, then you might be able to take it back to the store and get a refund. Now, there's no legal requirement for the shop to give you a refund. Yeah, they only have to give you a refund if the goods are damaged or not fit for purpose. They don't have to give you a refund just because it didn't fit you. But most shops will do that. There is a valid expectation that you will get a refund for returning those clothes because they don't fit you, and therefore there is a constructive obligation rather than a legal one. But in this case, the employee is suing us, so there is a legal present obligation. And is there a past event? Well, yes, there is. It gave us the date in the question, didn't it? They were suing us before the year end, and also the employee worked for us in the past, so there is also a past event. Next, is it probable? Well, no, it's not, because in the question it said that there was a 30% chance of them winning the case. So in which case it is not probable. And is there a reliable estimate? Yes, there is, because they're suing us for £50,000. So of the three conditions for a provision, one of them is not met. So we should not have a provision in this case. So in turn, let's have a look at the definition of a contingent liability. And here are the relevant paragraphs from the standard in the definitions area. So here, do we have a possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the entity? Well, that's the case here, isn't it? Because we can't control the decision made in the courts. But yes, there is a past event, as we've established already, and because there is a 30% chance, that means it's possible we may have to pay this rather than it being probable. And there's a second element of the definition. Again, we've got this present obligation that arises from past events, but it's not recognised because it's not probable. Again, that is the case we have now. Or it could be that the obligation cannot be measured with any sufficient reliability. Well, that's not the case, is it? Because we've got that 50,000. But yes, I mean, for both of these definitions, there's a possible obligation, but it's not probable. So that means we should conclude that this is a contingent liability rather than a provision. So let's return to the question now, and it's asking us to do a number of things here. So we're focusing on matter one, remember. So part one, identify whether the legal action should be treated as a provision or a contingent liability. Well, we've discussed that, haven't we? So contingent liability is the correct answer. And it says state one reason for your answer for 1 mark. So we've discussed quite a lot, haven't we, from what we've been talking about so far, but it only requires one answer here. So we don't want to talk about all the issues that we have discussed. So the key reason here is because we have that 30% chance of them succeeding, and therefore it's only possible. So notice I'm only writing brief notes here for the purpose of this video, but in your answer in the exam, you would need to make sure that you write out a full sentence explaining what we've explained already orally. And then state the accounting treatment of the matter in the financial statements for the year ended 31st December 20X1. So here's the accounting standard again, telling us that a contingent liability is disclosed. So there is no accounting treatment. We don't do any double entry. There's no debit, there's no credit, but we should disclose that there is a chance that the business may need to pay compensation to the employee. So again, in the answer, I'm just writing some brief notes here to summarise that. So let's move on to matter 2 now. On the 1st of January 20X1, so that's a whole year before our reporting date, Buzz Limited entered into a lease for a machine. Remember that leases are covered by IFRS 16. The company was required to pay an initial deposit of £600, followed by 3 annual instalments of £3,000 each, starting on the 31st of December 20X1. On the 1st of January 20X1, the present value of the 3 lease payments that fall due after this date is £8,325. The machine has a useful life of 5 years. The rate of interest implicit in the lease is 4% per year. Ownership of the asset does not transfer to Buzz Limited at the end of the lease term. So notice we have lots of numbers in the text, and all of them are going to help us to answered the question. So let's look at what the question asks us to do. It says, calculate the amount at which the machine should be recognised as a non-current asset in the statement of financial position at the 31st of December 20x1. So what we need to do first of all is decide, should it be recognised as an asset, or should we simply recognise the payments as expenses? IFRS 16 requires all leases to be shown as assets, but there are two exceptions. So we need to start by determining whether or not we have those two exceptions in this particular case. The question mentions that ownership of the asset does not transfer to Buzz Limited at the end of the lease term. So is that relevant? Does that impact one of those two exceptions? So here is IFRS 16, and it tells us in paragraph 5, a lessee may elect not to apply the requirements. So in other words, we're not going to show an asset if we have short-term leases or leases for which the underlying asset is of low value. So what does it mean by short-term leases? So here are the definitions. And a short-term lease is where we have a lease term of 12 months or less. So that doesn't apply in this case, does it? Because we've got a 3-year lease. And then the second condition was whether it is of low value. And I think we can agree from the figures they've given us that this is not a low value lease. And therefore, the two exemptions do not apply in this case, and we need to recognise the right of use asset. So the question was asking us calculate the amount at which the machine should be recognised at the end of the year. So again, let's have a look at the standard to tell us how should we initially recognise it. So here we are in the standard. So the cost will include the amount of the initial measurement of the lease liability, any lease payments that are made at or before the commencement date, but we also need to deduct any incentives received, and then we also need to add any initial direct cost incurred by the lessee, and then also we might need to dismantle this asset at the end of the lease term, and we'd include an estimate for those costs as well. So which of these are relevant for us in this particular case? So how much is the value of the lease liability? So it tells us in the second bullet point that the present value of the 3 lease payments is 8,325. And then do we have any initial payments? So yes, we have our initial deposit of 600. So there was no incentive. They didn't give us any money back for taking out the lease, and there's no mention of any other direct costs. There's no legal costs, for example. So the total cost we're going to recognise initially is going to be 8,925. Now it doesn't require the double entries for this, but let's clarify what those are to help us with our revision. So we're going to debit the right of use asset with 8,325 and credit the lease liability with 8,325, and then we're also going to debit the right of use asset with 600, and we would credit bank with 600. And that's the 2 double entries for those 2 transactions. But remember, we did all of this on the 1st of January 20x1, which was a year ago. So if we're going to be showing this asset in our accounts, then we need to be depreciating it. Now they've given us 2 numbers for the potential useful life of this asset. We know that we have 3 lease payments, and the asset has a useful life of 5 years. So ordinarily we would depreciate over the useful life, but we're only renting this asset for 3 years. The lease term is 3 years, so we need to depreciate over the lower of these 2 figures. And the lower is 3 years. So our depreciation is going to be the 8925 divided by the 3 years, which gives us a depreciation each year of 2975. So therefore, our net book value, which is the figure that we want for our answer, what's the figure at the 31st of December 20x1? So we have our initial cost of 8925 less 1 year of depreciation of 2975. And that gives us a net book value of £5,950. And then in part 2 of the question, it's asking us to explain our answer. Well, we've sort of done that as we've gone along to do the calculation, haven't we? So we're going to recognise that right of use asset at its initial cost, which is the present value of the minimum lease payments, plus any initial payments, minus any incentives, plus any direct costs. And then we're going to depreciate the asset over the lower of the lease term and the useful life. And that would earn us our 2 marks for that. Part C of the question tests IFRS 15 on revenue. So it tells us that Trunk Limited provides gardening services. The company has entered into a 12-month contract for regular garden maintenance with work commencing on the 1st of July 20x1. The agreed contract price is £5,000. At the 31st of December 20x1, Trunk Limited estimates that it's completed 40% of the work required. Okay, so notice we've got some dates here. So again, it might be useful for us to do a bit of a timeline to understand what's going on. So here is our year from January to December 20x1. And then we've started a 12-month contract starting on the 1st of July 20x1 through to June 20x1, or to June 20x2 rather. So that means that 6 months of the contract has occurred within our accounting period, and 6 months of the contract will still need to be completed. They've told us that the value of the contract is £5,000. So according to the accruals concept, we should recognise revenue according to the amount of services we provided. So we have provided services for 6 months. So there are a number of ways that we could work this out. We could take half of the revenue, but the question tells us that we've not actually done half of the work. Yeah, they estimated they've completed 40% of the work. So in that case, that would be a more accurate way of recognizing the revenue rather than simply time apportioning the revenue. So we should not use the time apportioning method in this case. It would be more appropriate to take the £5,000 contract value and multiply by the 40% to represent the work that we've actually completed. And in that case, our answer would be that we would recognise £2,000 of revenue. The question doesn't ask us for the double entry, but just so that we understand as part of our revision, we need to do a debit and credit for this. So we would credit the revenue with the £2,000. Now it doesn't say that we've invoiced anything, so we cannot debit trade receivables, but we can debit a contract asset, which is effectively some sort of work in progress account. And finally, we have a question about impairment covered by IAS 36. So we need to identify whether each of the assets above are impaired. So under IAS 36, we need to do an impairment if there's some sort of impairment event. We're not required to consider impairment for all assets. And the way to work this out, we need to be prudent and assets need to be stated at the lower of their carrying value and their recoverable amount. And the recoverable amount is the higher of the fair value less cost to sell and the value in use. So let's understand what we're talking about here before we start putting some numbers in. So we have this asset which is damaged, possibly, and so we've got the carrying amount, that's the number we have in the accounts at the moment, but we need to understand how much could we earn from this asset. Remember, the definition of an asset is that we have some economic benefit of holding it. We're going to be earning some money in the future from this asset. So we need to work out, will we earn money in the future from selling it, or will we earn money from using it? And commercially, we're going to choose whichever earns us the most money, and that's why we're choosing the higher of these. So if we sell the damaged asset, we will receive the fair value, although there may be some cost to selling it, so we need to deduct that. Or if we continue to use the damaged asset, so possibly the damage isn't significant, so we can carry on using it, so we're going to be earning cash flows in the future, and these need to be at present value. So in the question, they've given us some numbers, haven't they? So for asset A, we have a carrying amount of 12,000. That's the number in the accounts at the moment. But potentially it's damaged, and if it's damaged, we could sell it. So we could sell it for 11,000, or we could carry on using it, and the present value of the future cash flows is 14,000. So what should we choose to do? Should we sell it or should we use it? Well, we'll make more money from using it. So the value in use is its recoverable amount. And then we can compare with the carrying value, and we can see that the number in the accounts is 12,000. We could still earn 14,000 from this asset, which means despite it being damaged, the number in the accounts is still okay. So in that case, asset A is not impaired. We don't need to reduce its value because, for prudence sake, the carrying value is already at the lower figure. So let's consider asset B now. So asset B has a number in the accounts of 9,000. Potentially it's damaged, and if we sell it, we could earn 7,000 from selling it. And if we carry on using it, we would earn 5,000. So what should we choose to do? Commercially, we should sell it because we'd make more money by selling it than carrying on using it. So that's its recoverable amount. Yeah, that's the maximum we could earn from this asset. But the number in the accounts is 9,000. But if we can only earn a maximum of 7,000 from this asset, that means the number in the accounts is too high. It looks too good, doesn't it? So in this case, we need to recognise an impairment of 2,000. And then finally, for asset C, so in the accounts, it's got a value of 10,000. The fair value less the cost to sell are 15,000, so we could earn 15,000 by selling it. If we carry on using it, we could earn 13,000. So again, in this case, we would choose to sell it rather than use it, because we'd make more money by selling it. And the number in the accounts is 10,000, which is already lower than the recoverable amount. So again, because of prudence, we should show the asset at the lower of the two numbers. So it's already at the lower, and therefore this asset is not impaired. So for impairment questions, it's really useful to use that little decision tree to help you work out whether or not it's impaired.